We are very fortunate today to have Greg Heym, who is our chief, the Brown Harris Stevens chief economist. As far as I know, we're the only company with a chief economist. And we all at Brown Harris love Greg, and he is always very straightforward. So, Greg, I want to wish you a happy new year and thank you very much for being part of this video today.
Real excited to be here, Elaine.
I could tell by your face, Greg, that you're really excited.
Thank you.
Help me become the YouTube, what's it called? The YouTube sensation that I've always dreamed of being here. We're up close to 100 followers now. So anyway, Greg, we're obviously coming out of a challenging 2020, and now with the new COVID form seen in Saratoga right now, it looks like it's arrived in New York to give us more challenges. So we're going into an interesting 2021. So I would love to talk about some of the challenges we're facing in New York aside from COVID, and we'd like to touch on, let's talk about the mansion tax first. And at some point, I'm going to challenge you with a prediction for 2021. But can you tell everybody what the mansion tax is and how it poses whatever issues it may have for New York? So that would help us get started.
Well, the mansion tax is a tax that's been around for decades. That's levied on sales over $1 million in New York State, used to raise revenue. It was just raised last year by the state as a way to capture more money. There was actually a proposal for a dreaded pied-à-terre tax, which I'm sure we'll talk about in a minute. But in return, instead of doing that tax, they upped the mansion taxes as much as 290% on some transfers. To collect several $100 million. It's a tax paid by the buyer too. Normally transfer taxes are paid by the seller. In this case, it's a levy on the buyer. And here in Manhattan, $1 million is far from a mansion. But those taxes are hit hardest on properties over 5 million. Obviously, in this environment we're in now, where the city and the state and the MTA in particular are so desperate for money, all these taxes and tax hikes are going to sort of rear their ugly heads again. And there's no question, and additional revenue is needed. The real question is, what's the best way to get that revenue? And the state and city have a problem, as there's already been a large number of wealthy that have left New York over the past couple of years, and the virus obviously has temporarily increased that. I think a lot of those people will come back. I think people always come back and realize why they moved to New York in the first place. They can hide in the suburbs for only so long before they miss, everything once it opens again, and the vaccinations give us that hope. But I think it has to be done in a very careful way. For example, the pied-à-terre tax, which would be a tax on second homes, would be an annual levy, which would be on up to 13.5% on the assessed value of a condo or co-op over $300,000 a year. And the only crime of those owners is that it's not their primary residence. And many of them obviously aren't going to pay income tax, although they could very well be New York State or New York City residents who own investment properties.
So, Greg, let me ask you this. The mansion tax is for property over $1 million. So that's a one-time tax.
Right.
It's my understanding, I think, that the first $1 million they're not paying tax on, they're paying it on everything over $1 million.
No, they pay on the total amount. And a one-time tax is much more easily absorbed. Even though that we saw what this did to the market in the second half of 2019. We had a record number of luxury closings in June, it was the greatest month in the history of luxury real estate because the rates took effect July 1st. Our market never really got a chance to recover from that Obviously, we started to get a bit of a stride early in the year, and then COVID has kind of really changed all that. So when the market is as fragile as it is, I mean, let's face it, the supply of apartments over 5 million we measure it in years, not months anymore. And I think, what that's going to do to prices, and obviously we've had overdevelopment, but still, if you chase away a large pool of buyers with a recurring tax like the pied-à-terre tax, they're just going to walk away. Many that are already here are going to sell. It's actually going to cost the city and state more money than it will ever raise. You think of the buildings that won't get built, the construction jobs, the building service worker jobs, the retail jobs, the real estate brokerage jobs that are going to disappear because of this. And those are working class New Yorkers that get hurt. And I think the city and state have to realize it sounds great to say we're just going to tax the wealthy or we're going to tax oligarchs from other countries, but that's really not who gets hurt by these taxes, and it's really not who pays these taxes.
I think that's a great point, Greg, that you're bringing up, because we all think of it in a very isolated way, that it's the wealthy buyers who are being taxed. But when you break it down in a more granular way, and that is the working class people and the people who are doing the building and all of the peripheral people who are involved in the creation of these buildings, they're the ones that are also getting hurt.
And that's why the unions are against the building trades, and the service workers unions are against the idea of a pied-à-terre tax, because they know what it will do. Whether a rich person just pays the tax or sells his or her apartment, they're not really harmed. I mean, they can afford to pay it. Nobody questions that. But it's the jobs that they support that are left behind that suffer. And also, it will hurt everybody's property values. It doesn't there's no such thing as just a pied-à-terre apartment. Any apartment that could possibly be subject to this tax would see its value impacted, because the pool of buyers is going to go down and the supply is going to go up because of the people, thousands of people right away that will sell. And all you need to know, we do have a really good example of what this does. Vancouver is the only country really in the world that has a recurring pied-à-terre tax, anything remotely like what Senator Hoylman's bill is proposing. So what they did was, just like we did, they increased transfer taxes and their version of a stamp tax a couple of years ago, when they were the #1 Knight Frank ranked luxury market in the world. So they instituted the one-time tax, they fell in the rankings. Then they instituted what they call a vacant home tax, very similar to the notion of pied-à-terre tax. Now they're dead last in the rankings. It accomplished sort of what they wanted to accomplish, which was to get, all pied-à-terre buyers and foreign buyers out of the market. I don't know why we would want that here. We should want everybody to buy, and you think of all the taxes they do pay. If they earned income here, they pay income tax, but they pay full property taxes. They don't get the condo abatement, so they pay more than their neighbors just in that regard alone. They spend billions of dollars a year when they're here. This city is going to have to balance, in the state, this challenge of keeping vital services running, but also being careful not to chase more people out of New York, particularly wealthy. And Governor Cuomo is spoken about this. But with a supermajority right now in the Senate, it's really one-party control up there. They can override the governor's veto on anything pretty much too. So I think it's something that we're going to keep an eye on and keep opposing, and trying to educate everybody that this is not just free money that you take from rich foreigners who don't spend a lot of time here and take advantage of the city to protect their investment. These are people that pay billions of dollars in taxes, employ thousands of people every year, support so many vital industries. When you think of leisure and hospitality, which has lost almost half its jobs, and you think about restaurants and how they've been decimated, when everything opens again, we need all these people back in the city, and we need them spending money.
So why, Greg, do we think Governor Cuomo is not talking to you directly about this problem?
Well, we've had conversations, with the budget office, and they understand the riskiness of this revenue. It's never been tried in the U.S. before, too. It's not like a transfer tax or an income tax where you could just raise the rate and get a pretty good idea of how much money you're going to raise. That was the whole appeal to the mansion and transfer tax increases last year. They're already on the books. We'll just raise the rate at certain price thresholds, and we'll collect, a couple hundred extra $1 million. With this, there are many ways to get out of paying this tax. You can sell your unit; you don't have to pay it. You can put a parent or a child in the apartment or the home. You can rent it to someone who makes it their primary residence. So with so many ways to get out of it, the revenue numbers just keep shrinking and shrinking and shrinking to the point where the latest forecasts that we have are showing it won't even raise $100 million a year, which is a rounding error, obviously, in its New York State budget. So for the damage it's going to cause and the hundreds of millions of dollars in other taxes that are going to be lost, again, those construction and property related taxes and sales taxes, it's a bad idea and it's a net loser for New York, and they should look elsewhere to solve their budget problems.
Right, it's very interesting that you provided some interesting loopholes to people putting a child in the.
Well, I didn't. They're in the bill. The extensions are actually, you want to make sure, because you call it a pied-à-terre tax, but a lot of people thought, well, that doesn't mean investors, right? If somebody owns a couple of condo units they rent out, they're not going to pay this. And originally, yes, they would have. But now, as long as they rent their units to people that make it their primary residence, or put a child or a parent in there, they can avoid paying it. Or if you have a condo or co-op, if you can get an appraisal, a state certified appraisal that says it's worth less than $5 million, you can also get out of paying this tax.
Now, you mentioned 300,000 though. Can you address that?
Yeah. So for those of you who don't know, and be grateful you don't, because it's confusing, property taxes on and values for co-ops and condos are not based on sales prices. Our old antiquated property tax system requires the Department of Finance to treat co-ops and condos as rental buildings and value them using income from similar rental buildings in the area. So the market value of a condo has no relationship to what it would sell for. It's not based in actually any sales value at all. That's why you could find two condos selling for the same price with vastly different taxes. So what we pointed that out to the sponsors of the bill, that you can't tax on a unit two different ways. You can't value it with an income approach and a sales approach. They said, okay, so now we're going to use an assessed value threshold of $300,000. Which they thought equated to a value of $5 million. We proved that wrong, and that's why that appraisal exclusion is in there, because again, the lack of a relationship to actual sales market value and what the DOF determines every year. And if you want to know more about it, reach out to Elaine in the group, and they can help you understand your tax bills. I'm fortunate enough to, maybe not fortunate enough to teach classes in property taxes at REBNY, but I do teach them with a former finance commissioner. So we have a lot of fun going through like Mayor de Blasio's tax bills and stuff like that, and showing the inequity in the system. It's a really old, broken system that is vastly confusing to, I would assume, the majority of New Yorkers.
Definitely confusing. I've heard you speak about it many times.
I'm sorry I had to go through that.
When you reach out to me, folks, I'll be reaching out to you. Greg, can you give us, I know everybody wants a prediction. Everybody wants to know what to do next. And I'm always saying you can't time a market, but you are the chief economist. You see what's going on. I can tell you we're making a lot of sales at much lower prices, but what's your prediction for?
Well, we've seen sales bottom. There was a little bounce up in the fourth quarter closings, and we're starting to really see the sort of what the impact on pricing in different segments has been. You know, you can't slap a COVID discount on every apartment. Everybody always wants to know how much are apartments down. Is it 10, 15, 20? You have to follow the inventory. And obviously there's a lot more luxury product than anything else right now. And larger co-ops are seeing the biggest price declines right now. Their inventory is really shot up. You know, we knew that we were shut down for a couple of months. We knew the inventory was going to hit the market before the buyers were totally back. Now, as you said, fourth quarter contracts signed in Manhattan were higher than the fourth quarter in 2019, but the fourth quarter in 2019 wasn't a great quarter. But still, that's positive news. What this means is, you know, we have an end in sight to this horrible pandemic as more people get vaccinated. We're going through a rough patch now. Hopefully that'll turn around soon. This is the opportunity I think that buyers have been waiting for. You know, you're never going to find the bottom of the market. I'll tell you when it happened, 6 to 12 months after it happened. You know, there's a lag between contract signs and closings. You can't time the stock market, and there's 8 billion indicators for that in real time that you can check. So I think that if you go out there and look at what you could get compared to what you could have gotten, maybe if you're looking before the pandemic, you'll be very pleasantly surprised. And as deals continue to happen and we have more data, we get a real feel for where the market needs to be. And I think we're getting close to that point in most segments. But don't expect a fire sale for every type of apartment. You know, I said there's a lot of larger apartments, but getting an affordable studio in Manhattan has always been a challenge. But the record low mortgage rates will help with that. I think that, you know, again, this is an opportunity for somebody who's been waiting to get in the market for the first time, waiting to trade up, to really take advantage of a high inventory environment and great low rates. And obviously the stock market had a great year, finished at records at the end of the year. So, you know, if you've been thinking about it, look and see what's out there. And I think for sellers, keep doing what you've been doing. You have to be realistic. You know, there's no such thing as what, you know, aspirational pricing or what you think it may be worth or what you're looking to get out of it in this market with all this competition you have. You have to be serious, and you have to really look at your competition and see if you're accordingly priced, because you're just not going to get the interest. Even though the market's busier, that doesn't mean everybody's phone's ringing.
Yeah, that's a perfect note to end on. Greg, I cannot thank you enough for being part of our team, so to speak, and sharing your wisdom, and we really appreciate your time. Thank you so much for being here and being with Brown Harris and being with the Elaine Clayman Justine Bray team.
Well, thanks, and Happy New Year to Elaine and all of the team over there. I love you all.
We love you too. Thanks, Greg.